How the economic machine works in 30 minutes. The economy works like a simple machine, but many people don't understand it, or they don't agree on how it works, and this has led to a lot of needless economic suffering. In the short-term debt cycle, spending is constrained only by the willingness of lenders and borrowers to provide and receive credit. When credit is easily available, there's an economic expansion. When credit isn't easily available, there's a recession. And note that this cycle is controlled primarily by the central bank. The short-term debt cycle typically lasts 5 to 8 years and happens over and over again for decades. But notice that the bottom and top of each cycle finish with more growth than the previous cycle and with more debt. Why? This is the long-term debt peak. Debt burdens have simply become too big. For the United States, Europe, and much of the rest of the world, this happened in 2008. It happened for the same reason it happened in Japan in 1989 and in the United States back in 1929. Now the economy begins deleveraging. In a deleveraging, people cut spending, incomes fall, credit disappears, asset prices drop, banks get squeezed, the stock market crashes, social tensions rise, and the whole thing starts to feed on itself the other way. As income leveraging process can be horrible if handled badly. If handled well, it will eventually fix the problem. It takes roughly a decade or more for debt burdens to fall and economic activity to get back to normal, hence the term lost decade. In closing, of course, the economy is a little bit more complicated than this template suggests.
The year 2019 still may, and the IMF was in both of those, I think, still may be one of the fastest global growth years on record. And America, which is a big part of the global economy, is growing at 3% plus, and it's just powering through. People coming back to the workforce, wages are going up, companies are spending more in capital expenditures, confidence is very high.
All right, that's Jamie Dimon at JP Morgan Chase. Remember, that's the same company that Warren Buffett's Berkshire Hathaway has a $4 billion investment, and he added to that. Let's get to read from Market Watcher.
We focused on this now because it's been a decade since the global recession of 2008 and 2009, and some interesting and worrying vulnerabilities are also popping up at the moment. In 2008 and 2009, the dominoes were really set up for quite a nasty financial and economic crisis. This time, the economic vulnerabilities aren't quite as large. They're large enough that we could see a slowdown in GDP growth, a slowdown in trade, and things of that nature. The real risk is that our lack of preparedness and the lack of room for global cooperation.
Here we can see the curve of the differential between the value of the 10 years and 3 months obligations. Investors obviously want to have a higher return when they invest in the long term. So when the curve goes down, it means that investors are investing more on 10 years bonds. This means that they do not trust the 3 months economy. In fact, in the past, whenever this indicator went to zero, we had a recession. From the point it goes down, the recession starts, as per our records, between 140 days after the day 1 up to 487 days. Our day 1 this time was March 22, 2019.